SoftBank is staring down a $1 billion wall that isn't made of concrete, but of pure valuation skepticism. Just weeks ago, they slashed their target for borrowing against OpenAI from $10 billion to $6 billion, and now the talks have completely stalled. Why would a lender walk away when the asset is arguably the most valuable in tech history? The answer exposes a brutal new reality for high-stakes finance. Liquidity isn't just about owning a piece of the pie. It's about convincing others that the pie actually exists at the price tag you're asking for. In this video, we break down exactly why the OpenAI margin loan deal collapsed and what this means for the future of AI investment and corporate leverage. The core issue here is simple arithmetic wrapped in a complex financial product that has never been tested at this scale before. SoftBank originally pitched a $10 billion margin loan, essentially asking creditors to lend them money backed by their OpenAI shares. But lenders are seeing the math differently. If you borrow $6 billion against an asset, you typically need collateral backing it up significantly more than 1-to-1 due to risk premiums and volatility buffers. The market is currently implying that for SoftBank to get even half of what they asked for, the underlying value of their OpenAI stake might be viewed as much lower than their internal models suggest. Consider how this plays out in a boardroom. A lender isn't just looking at the headline valuation. They are stress-testing the asset against potential downside scenarios. If SoftBank wants $6 billion liquid now, and the loan structure requires an 80% loan-to-value ratio to be safe for the bank, that math implies an OpenAI stake worth nearly $8 billion on its own. But if lenders balk, it suggests they see a world where that stake is worth less, or far more volatile than SoftBank admits. This 40 to 50 billion gap in perceived reality is why the negotiations froze. It's not that anyone says no out of spite. It's that the numbers simply don't balance on their books without a massive haircut on the collateral value. Beyond the raw numbers, there is a psychological and structural barrier known as the Volatility Premium. OpenAI operates in a sector defined by exponential growth, but also by terrifying uncertainty regarding profitability timelines and regulatory hurdles. Margin loans are typically designed for stable assets like blue-chip stocks or bonds where price fluctuations are predictable. AI, however, behaves more like a startup venture than a mature corporation. When you try to use a hypervolatile asset as collateral for a massive loan, the interest rate demanded skyrockets, and the risk assessment becomes almost impossible to clear with conservative financial institutions. Think of it this way. If the market dips 10% tomorrow, does SoftBank still have enough equity in OpenAI to cover their debt obligations? Lenders are terrified that the asset backing the loan could drop so fast that they are left holding a bag of paper while SoftBank walks away with cash. This fear creates a standoff where SoftBank needs high liquidity to fund operations or acquisitions, but lenders demand lower leverage ratios to protect themselves. The result is a stalemate where SoftBank has to come down from their valuation expectations to meet the safety margins required by traditional banking institutions, which is politically and financially difficult for a company that positioned itself as an open investor in the future of intelligence. There is also a fundamental disconnect between SoftBank's internal optimism and external market sentiment. For years, SoftBank has operated on the belief that OpenAI would become the dominant infrastructure layer for all global computing, justifying a massive premium valuation. However, the broader financial ecosystem is increasingly cautious about overpaying for unproven business models, especially in a high-interest rate environment where capital efficiency matters more than ever. Creditors are looking at competitors like Anthropic or Google's Gemini and asking themselves if OpenAI truly holds a monopoly worthy of a $10 billion premium loan backing. When negotiations stall at this stage, it often signals that the external market is pricing in a slower path to profitability or potential regulatory headwinds that SoftBank hasn't fully accounted for in their leverage strategy. It's not just about whether OpenAI succeeds, it's about how quickly they can succeed and whether that success translates into immediate cash flow that reassures lenders. If the timeline extends beyond 3 years, many conservative funds simply won't touch a margin loan of this size because the opportunity cost of tying up capital in such volatile collateral is too high. This highlights a shift in how we value AI startups, from what could it be worth to when can it prove itself. What this stalemate teaches us is that the era of easy, unlimited leverage for megacap tech assets may be ending. We are seeing a transition where owning a piece of AI isn't enough. You need to own a profitable, cash-flowing engine attached to it to unlock massive liquidity. For investors and founders alike, this is a critical lesson on rate strategy. The more money you need to earn or raise, the more strategic your rates and valuation assumptions must be. Many fear that clients, whether they are banks or institutional lenders, will say no or refuse to pay premium rates for risky assets. But in this case, it's not about rates at all. It's about whether the collateral holds up under scrutiny. SoftBank has now trimmed its target to $6 billion, a move that acknowledges reality rather than fighting it. They have recognized that lenders are hesitant on valuation and that pushing harder would only burn bridges with capital sources needed in the long run. This isn't a failure, it's a recalibration. It shows that even the most powerful players must align their internal valuations with external market realities to access liquidity. For anyone watching this space, the takeaway is clear. In the age of AI, leverage is no longer a given. It has become a privilege earned through proof of stability and profitability, not just promise of future dominance. So there you have it. SoftBank's push for billions against their OpenAI stake hit a wall because the market simply won't bet on volatility without ironclad guarantees. They had to scale back from $10 billion to $6 billion, only to find lenders still hesitant, forcing a complete pause in negotiations. This isn't just bad news for one company. It signals a shift in how we finance the future of AI. We are moving from an era of faith-based valuation to one grounded in hard numbers and risk management. If you found this breakdown helpful, make sure to hit that like button and subscribe for more deep dives into the tech economy. And let me know in the comments, do you think SoftBank will ever get their full $10 billion, or is the new $6 billion ceiling the permanent reality? Let's discuss below.